Okay, Daniel has joined.
Okay. Is that okay, the height?
Yes, it looks okay.
Yeah, because I made it taller.
Okay, Daniel is here in the call.
Okay, great.
Hi, Manuel. Sorry for last time. Thanks very much for your patience.
No, not at all. All good things are worth waiting for. So
I hope so.
yeah. If your camera can be a little, you cut off your head a little bit. So just oh, unless I can't see that. I mean, like
yeah, it's
okay.
It's okay. Yeah, it's okay. Yeah.
I'm sorry.
Okay. I just moved it. Do you want me to move it back again?
Oh, no, it's fine. So actually, now it needs to be a little lower. Because I thought just now, to me, you looked like you had cut off your head. But
right.
Is that all right,
perfect.
Usama?
Yeah. Yes, you did. Perfect.
Okay, perfect. Okay, excellent. Yeah, we're both good. Okay, and just to let you know, we can always edit anything that you think you would like to redo or something. That's how the video works. And yeah, and that's it. So we'll just have a sort of we try to make it flow as far as possible, and then if there's anything you want to revisit, we can do that part again. So I'm going to start by introducing the session, but before I do that, Daniel, you've always been with StanChart, right? So I don't need to say like you're coming from somewhere or something like that. When were you given this responsibility of global head of sustainable finance?
It's a good question. I have done other things than Standard Chartered, believe it or not, but it was a long time. Just hang on, let me tell you.
I just want to give it a start date of some kind. So like, since when?
So January 2019 is what my LinkedIn profile says.
Got it. So the interview will focus, I mean, it'll be wide ranging. It'll be a little bit about StanChart and a little bit about your opinion on where sustainable finance is going, both in financial services, in the financial services industry, but also, in general, okay, so three parts. One is StanChart, the other is sustainable finance in the financial services industry, and then in general, some of you, I'm going to be like tapping your mind on your brain on this. We have a just as a background also. We started a program about 3 years ago now called Wealth and Society, and that program is an adjunct to the Asian Banker in that we're looking at impact. We were already looking at impact investments 3 years ago under this program called Wealth and Society. It was directed at our private banking, wealth management type business. And I didn't want to get into wealth management or private banking per se without a kind of overriding theme. And the theme at that time already was like, hey, wealthy people need to think about sustainability and being relevant, impact investment and stuff like that. So this interview will be promoted to the readers of that as well. So Wealth and Society, just to let you know. Okay, good. Okay, so I'm going to do the introduction first. Sometimes what I do is I do the introduction, and then after that we have a great conversation, and then I realize that I need to do the reintroduction again. So
that's right.
Okay, so just to let you know. Okay, today I'm going to be speaking to Daniel Hanna, who is in London right now, or in the UK, somewhere in the UK, now that there's a lockdown. And Daniel is the global head of sustainable finance at Standard Chartered Bank. And in fact, he is actually the first global head of sustainable finance of any financial institution that I've spoken to, or I'll be speaking to. And this conversation is going to be very important as I piece together the elements of impact investments, financial institutions, and the whole capital market that is evolving around impact investments. And the reason Daniel captured my attention was an announcement that Standard Chartered Bank made last year that it was going to set aside $1 billion of its own resources, its own funds. I follow these numbers carefully because I'm also interested to know how much of that money is backstopped by government guarantee. And because StanChart's $1 billion commitment was not for any one country, it was globally applicable. So I don't think it was backstopped by any government, which is highly admirable, because many other banks around the world were announcing impact investment type objectives, always with some form of government backing. The commitment that financial institutions take in repurposing their own business, as well as funding and supporting global and local initiatives, is very important. And the steps that StanChart has been taking are transformational, not just for StanChart, but for the financial services industry as a whole. So my conversation with Daniel Hanna will be wide-ranging. I want to know a little bit about where StanChart stands, what it's doing, and then to build on that, to tap on his brain in terms of his insights and an idea of how he thinks about impact investments in general. So Daniel, thank you very much for joining me today.
It's a real pleasure. Thank you very much for inviting me to speak. And I feel honored to be the first head of sustainable finance to speak to you.
And therefore, you're going to be answering some of the hardest questions, and the rest of them will be getting it easier. Now, although I came across the fact that StanChart had made that commitment, I noticed that StanChart is not in any of the league tables, as it were, right? The bond issuance league table and so on at the moment. And I also noticed that many financial institutions around the world are falling over themselves to repurpose or to relabel a lot of the lending and the bonds that they've issued to be sustainable finance in order to keep up with the trend. It's more or less fashionable, right? So tell me a little bit about at which point did you personally get involved and be appointed this very important position? Your appointment itself is an important milestone because it indicates the institution's commitment to sustainable finance, and how you and your institution repurposed or configured this whole approach to impact investments that you have right now.
Well, thank you very much. I think a great question to start with. So, I think first of all, let's set a bit of a scene. StanChart has effectively been doing what you might call sustainable finance for a very long time. Our first ESG risk team was set up in 1997. We were one of the original signatories to the Equator Principles, the best practice that the private sector sets for doing infrastructure. We set environmental targets in I think it was 2002, 2003. And we actually issued our first impact report in terms of our financings in 2006. So we've been doing a lot of what gets aggregated as sustainable finance for quite some time. What was new with my appointment was just bringing that all together under, if you like, one umbrella and having a really core team that is going to drive it going forward. And I've been doing that now for 2 years. And one of the unique things about Standard Chartered in sort of the financial institution space is that we've combined, if you like, our risk team, so the team that analyze the risk that our clients have in their environmental, social, and governance issues, with effectively the team that finances the opportunity to drive the shift to a low carbon future and to becoming more responsible. And I think that's very important because we see the risk and the opportunity as being absolutely part of exactly the same equation. So if you look at, for example, Asia faces probably the biggest risk from climate change in terms of the impact in terms of rising sea levels and the greatest impact to its GDP and to its people from flooding and extreme events from weather. But at the same time has the biggest opportunity to leapfrog to low carbon business models. And so we wanted to put that conversation in one place because I think you need to be credible, you need to be doing both that kind of risk analysis and also that opportunity financing.
Right. How much of your appointment in the last 1 year or so was relabeling everything that you've been doing so that you can report better, you can be more visible, and just even before the repurposing, it's just the relabeling aspect of it?
I think you've raised a really important point, and it's actually one that I think the industry is not having an honest conversation around. which is that a lot of green finance, frankly, is relabeling. In sort of development finance speak, and I spent 5-6 years running our public sector business, engaging with governments and financing the multilaterals. It's not additional. It is not creating new financing, driving to really where it matters. And so I think this obsession, for example, with green bond league tables and the like is completely misplaced. We need to be having a greater focus on actually driving impact to where it really matters. And that, for me, is really in a large part into the emerging markets, where there's this opportunity, but there's also this risk from climate change and financing the Sustainable Development Goals, and a big financing gap at the moment. So from Standard Charter's perspective, yes, there are certain things that we were doing already for a very long time, but there are some things that we've absolutely done for the first time. So look at, say, product innovation. We did the world's first blue bond, a green bond, like a green bond, but this one was driving towards oceans and creating a sustainable ocean economy, which we did with the Republic of Seychelles. Or our launch of deposits, which are linked to the Sustainable Development Goals. The first bank to launch a deposit program where you can put liquidity with Standard Chartered, and that liquidity is ring-fenced to go to the SDGs. Or to take another example, the recent work that we've done with IIX in Singapore around a women's livelihood bond, creating capital that is driving to underprivileged women in South Asia. So I think there's a lot of areas of innovation where we're really trying to think about how do you catalyze capital to where it's really needed, not just raising another bond, which could have probably been done anywhere.
So what do you have as measurements in your institution itself that you're putting as milestones that you need to achieve? You know, what kind of numbers are you setting yourself for? Like, you know, it can be on the balance sheet, it can be also size of issuance and stuff like that.
Yeah, so I think there's a couple of things that we have announced in the last couple of years just that talks to exactly that. So first of all, we were the first bank to say that we were going to phase all our clients away from coal anywhere in the world, both in the developed markets and the emerging markets, by 2030. And I think that signaled a really important, you know, we had a big debate about this, to be honest, in Standard Chartered, because clearly a lot of economies and livelihoods depend on coal. And frankly, in our footprint, 1 billion people have no access to power at all, whether it's any kind of power. So, you know, we were very thoughtful around, okay, do we really want to do this? Well, we're in a climate emergency. And so I think it's really important that we took that step, but also we want to work with our clients to transition them to alternatives, which is why we also at the same time made a commitment to fund $75 billion of clean technology and sustainable infrastructure with a focus on emerging markets. And for us, I think that's key. How do we help emerging countries and Asia in particular transition over the next decade to what I think will be a big opportunity as well, but one that is much more aligned to the fact that we've got such a big crisis in climate going on at the moment.
Yeah, but it's still not giving me the numbers that you're looking at, you know. So how much of your loan book needs to look like ESG? How much of your, you know, goals of, you know, capital raising should look like that? How much of your, you know, basic lending, you know, right down to, if you're going to, the interesting thing about StanChart is that you are an amazing, you know, small business bank, you know, bank around the world, you know, so you are intimately involved in exactly the emerging market countries that will benefit from impact and from ESG. So, you know, like percentages of changes you need to see on your balance sheet.
Yeah, and I think it's really important, as you say, that we have these sort of targets, but more importantly, I think transparency around where our financing is going. And it really comes back to that point I was mentioning earlier around not just saying that something is green or sustainable for the sake of it, but actually making sure that it has a real impact in driving change, which is why we've started publishing an annual impact report. We put one out a couple of months ago, and it actually quantifies the amount of financing that is directly linked to the Sustainable Development Goals. And you can see the framework of how we've worked that out. It shows that our financing over the last 12 months have saved, I think, 736,000 tons of carbon. And that $3.4 billion of financing that we've clearly identified and had assured is also focused very much on the emerging markets. In fact, 91% of our financing that is sustainable finance goes to the emerging markets. 86% of that goes towards low-income countries. But we've got a lot more work to do. This is just very much at the beginning. If you look at the amount of financing that we need to scale globally, you're looking at a gap at the moment of about $2.5 trillion a year to hit the Sustainable Development Goals. And then in terms of financing climate as well on top of that, that's extra capital. So we've got to work very quickly, not just as a bank, but I think as an industry, to see how we can drive capital to where it really matters.
And is this a rewarding business to be in at the moment? There are indications like the Bank of America put out a report saying that more than funds that were invested in impact performed 3% more than S&P 500 in the last 5 years. As Bank of America put out that report, Morningstar said 77% of ESG funds last longer than 10 years, as opposed to, other funds. So, is it a rewarding business? Do you have good news to say about, that impact is good for business?
Yeah, I think it is. And I think particularly in Asia and wider in emerging markets as well. I think you mentioned that Morningstar report. It showed that ESG funds outperformed in 1, 3, and 5 year categories. But I think when you talk about reward, it's important to think about this in two parts, because actually reward comes from A, driving sort of excess returns, but B, from avoiding risk issues and failures there. And I think what we've seen increasingly is the evidence that shows that ESG, one, is correlated with a sustainable business that's capital accretive over a period of time, or that shows excess returns. But two, really importantly, it helps avoid downside risks. The IFC put out some research that shows that ESG funds outperform in terms of a return on equity and on a return on assets. And part of that, frankly, is a company that runs good ESG is probably just a very well-run company. But at the same time, we see a big opportunity here. We put out a piece of research last year called Opportunity 2030, and that showed that within 15 markets, most of them I think half of them were in Asia, and there is a $10 trillion investment opportunity over the next 10 years aligned to just 3 of the SDGs. So I think that's a big opportunity to go after. And then on the same time, if you think about what's happening on carbon prices, I think there is a growing consensus that you're hearing from many different places in the regulatory space that says, look, we need to start pricing carbon appropriately. And so if that carbon price starts moving up, then if you're not an ESG company, or if you're not effectively moving to that low carbon business model, you're likely to hit a negative hit. And so I think ESG basically will see an outperformance, not just from sort of excess returns perspective, but also from an avoiding risk perspective.
Right. So how much of what you're doing in sustainability is going to start showing up in StanChart's own balance sheet, quarterly reports coming up? How much of it is, capital, reshaping capital basically, and rewarding the institution for being more impact conscious. And I want to bear in mind also that, the BIS has put out its report on that, right? So a lot of that had to do with the getting out of coal as an important business model for all banks around the world. But beyond that, what you're claiming to be doing, which is being closer to the ground, being environmentally conscious and as well as socially responsible, all that is good. But do you personally have responsibility that has to show up in the balance sheet of the bank itself, in the near future?
Yeah, so we run a sustainable balance sheet. It's a virtual balance sheet that matches off our assets and liabilities within the bank, precisely so that when we do our liquidity products, so liabilities or deposits, or when we raise our sustainability bond, we have to have that sort of ring-fence pool of assets on the other side that's sustainable. As well, just to make sure that that's pretty robust, and we're driving both of them at the same time. So absolutely, we've got a balance sheet, we've got a P&L, and I think in the coming coming years, you will see the bank probably starting to move to report on that basis as well. We're not clearly there yet, but the focus of the institution is very much to make sustainable finance one of our big core pillars. We see a big opportunity, and we think this is really important for our clients, and I think we're hearing a lot of demand from our clients across the whole bank, whether it's retail, whether it's high net worth individuals, corporates, institutions, and governments, for this kind of focus.
Do you personally wish that the BIS would reward banks for being sustainably conscious on its balance sheet, the loans that you issue, the bonds, and that it'll take off some of the capital requirement from that or reward banks for moving in that direction. I mean, it's not showing up in the capital intensive nature of banking.
Yeah, so I think it's a really interesting question. I think one where effectively, I think within sustainable finance, you've got a real alignment between what the banking sector wants to do with what regulators want to do and what investors want to do, which is drive more capital into these sort of areas. And so I do think there needs to be a question around the sort of the capital treatment of some of this. And you've seen a little bit of this happen. So for example, in Europe, they've taken the decision to reduce the RWA for qualifying green projects that meet certain criteria. And I think actually that's something that I would encourage, say, Asian regulators to be looking at very carefully as well, because there is clearly a big financing gap that needs to happen in order to see the big economic shift towards net zero, towards being much more sort of aligned to low carbon business models. And I think there is a big opportunity for Asia here in particular.
No, thought bubble, right? Think about capital adequacy and also rating, right? At the moment, a lot of bank rating, or the traditional bank ratings, AAA, you actually have come from a safe country, low risk and so on. But then when you add the impact component, you actually have to come from a high risk country where the lending that you do is making a big difference to the local community and all that. Now, thought bubble, do you see regulation evolving eventually where it will reward banks and and bank capital adequacy requirements if they were more attuned to impact, and therefore it won't be the highly developed, safe countries that will be rewarded, but the countries which are transformational and using bank capital well?
I mean, I think so. Let me take that a little bit in turn. Huh? Sorry, thought bubble. Yeah.
Yeah, I know, because here what I'm testing is more like, what do you think are missing in that process if we're working towards that?
What do I think is missing in terms of getting that capital to move? Or
no, in getting a regulatory regime where regulators will be rewarding financial institutions which are more impact conscious, taking capital requirements off their back or rewarding them for it, and where because of impact, the whole thinking in terms of a well-run institution is one which is relevant, to the society that it serves, instead of being just safe and well-developed.
Yeah, I think it's a really interesting question, but I think it needs unpacking a little bit, because I think from a capital adequacy ratio and from if you like, a regulatory prudential regime, what the regulators are trying to ensure is that the bank is effectively safe. And so here, I think where you are going to see increasing focus and work from the regulators and frankly from banks as well, is to show that there is a correlation between, if you like, the risk that sits on a balance sheet and the ESG. And certainly I believe that, right? So whether that is in terms of the sort of physical risk or transition risk that comes from climate, so the impact that more adverse weather shocks are going to have on physical infrastructure, or that certain business models are going to be able to transition better than others because of likely regulatory change in terms of carbon prices and others. I think that is going to start getting reflected in terms of that risk prudential, and effectively then that will drive some banking change over the coming years. The piece that you're talking about, though, which I think is really interesting, is beyond that, which is, okay, fine. So that's kind of the risk aspect, but how do we really catalyze this increasing flow of capital? Well, I think interestingly, this may actually be happening more on the investor side at this stage. And I think you are now starting to see a lot more momentum and focus around whether you call it impact financing or sustainable financing or ESG financing, with capital flows kind of moving this way. And I think that's where we see a real opportunity for Standard Chartered, where to link, if you like, the capital flows from the big centers to the ground, to where the change can really happen, where the opportunity is for us as well. So I think from a regulatory perspective, we're going to see that continued focus on risk. I think from the investor side, that bigger focus around impact is going to happen. And I think, to put that in context, we've got quite a lot of work to do. We put out a piece of research towards the end of last year called the $50 trillion question, where we went and asked investors who have $50 trillion of assets under management, how aligned they were to the Sustainable Development Goals, how aligned they were to this. And actually, I mean, somewhat disappointingly, 20% didn't have any knowledge of the SDGs, and only 13% were aligned to the Sustainable Development Goals. And of all that 50 trillion, less than 22% was focused on Asia. And I think the sort of broader emerging markets was sort of single digits. So we've got a lot of work to kind of move the big pools of capital to these areas. And I think that's hopefully where we see momentum building, but more work to do.
So a lot of that seems to be still educational, right? And aligning what is already there. Do you publish, what your ESG commitments, or rather a checklist, that an issuance client, for example, who wants to work with you, what should they be adhering to before they would qualify for one of your green bonds or whatever you want to tag them with? Do you have a checklist that you give your clients?
Yeah, no, very much. And I think that's on many different levels. So first of all, we have, if you like, our own aspirations, our own sustainability aspirations that are up on our website in terms of what we as an institution are doing, both in terms of our financing, but also our own operations being net zero by 2030, the fact that we're reducing our own sort of emissions and also working with our clients to reduce theirs. Then we have effectively the framework of what we define as sustainable finance. That is, again, up on our website, and it links our activity directly to an SDG and kind of the impact that we kind of expect to see on it. And then beneath that, I think we're working with clients all the time to effectively define, to show them effectively, as you say, a checklist of, okay, so if you want to think about how you can raise sustainable finance, here's what you need to do. We're going a step further this year, which is we're publishing transition pathways on an industry by industry basis that says, look, if you're in this industry, here are the 3 or 4 big levers that you can pull that will move you to a low carbon business model. And this is how we can help finance you in that journey.
Right. And how much of that is being communicated internally in the organization, right from the origination of lending to issuance, your employees, your staff, right? So when you say transitioning pathways, how much of that is now embedded in your own evaluation processes, what you do within the organization?
Yeah, it's a really great question, and it's certainly a big area of focus for us. I mean, I think my aspiration, if you like, is that in a few years' time, StanChart doesn't need a sustainable finance team because it's just so embedded into everything that we do that I sort of do myself and my team out of a job. And I think that there's a couple of things that you really touched on there. One is putting it in the KPI. So sustainability is in everyone's KPI at Standard Chartered already. And then the second thing is education, and that's really key. So we're running and developing a global curriculum for all bank staff, not just the sort of frontline people that deal with clients, but the whole bank, in terms of sustainability and sustainable finance. And then effectively are building several layers into that so that you can become qualified within the bank at kind of a sort of practitioner level and kind of an expert level. And that's a really big area of focus. On top of that, we run a champions program where effectively anyone can volunteer, be part of the work that we're doing in sustainable finance. And we've got, I think, 8,000 staff signed up. So it's a big area of focus in the bank. And I think one where staff actually are really engaging very positively in it.
Right. Last year was a very busy year, right? I mean, not just for StanChart, just globally in impact and ESG. I see all the numbers like, the first quarter of the year was very slow and then it picked up very quickly, very, very busy for everybody. Tell me a little bit about that $1 billion commitment that you made, that you announced last year. And how busy has it been? What happened last year? And actually, something that I wanted to test with you is this: how much of last year was relabeling, and how much of the last year was real? Not just for you.
No, for the industry. I think so. COVID is, there's the joke that goes around about COVID. Who's done more to digitize your industry? And it was COVID. I think in some ways, COVID was also a massive accelerant for the other big trend that I think is, everyone's talking about at a board level, at a personal level, which is sustainability. So there was definitely a significant shift up. And I'll give you a couple of Stanchart specific anecdotes to go with the sort of record numbers you've seen in the market. The single biggest inflow that we had into our sustainable deposit program was at the height of the COVID pandemic in Asia. The number one fund, sort of the halfway point on our high net worth, our private banking platform, was an SDG fund. So we saw a significant inflow into our products, a significant uptick in terms of the percentage of financing of projects that we're doing, from everything from renewables to anything else. So we had an incredibly busy year. I think really encouragingly, 2021 has started, if anything, even faster. And I think we've had some fantastic tailwinds in terms of, for example, China's net zero commitment towards the end of 2020, and now the US rejoining Paris. So this is clearly a mega trend. It's not, I think there's been some commentary in the markets about whether it's a bubble or not. I think we're literally just at the beginning of this. It's very much going mainstream. You very kindly mentioned, I think, the proudest moment I've had in banking, actually, which was Stanchart's commitment to fund $1 billion on a non-profit basis for our clients that are actively involved in the fight against COVID. I was very proud the bank took that decision, and it has been a privilege to effectively deploy that capital. And we have some really impactful, fantastic stories. I mean, we've done everything from finance, PPE production out of China, to medical provisions, so medicine provision manufacture in Bangladesh, to helping companies shift production. We helped a steel manufacturer shift and to make oxygen tanks. And you know, I think that kind of impact is really it's been a really important contribution, I think, to what has been a crisis for all of us over the last 12 months.
But it was not charity, wasn't it? It was still a business. Run by me the risk elements of running a program like that. $1 billion commitment worldwide, and then who comes to talk to you? And what are the conversations like, and what you need to look out for in terms of risk as a result?
A very good question. So I think, first of all, you're right. It's a non-profit, but it is still a loan. So it's not a grant. So we do need the money to effectively come back to us. The margin that we charge on it, though, was a fixed margin across any client, anywhere, of any kind of risk type. And it's a really tight margin. So the modeling that we had to do at the very beginning was to work out roughly what a portfolio would probably look like on an industry, geographic, and credit grade split, and then say, okay, well, this is roughly what the sort of potential risk of this fund will be. So there's that kind of credit modeling we did up front. But there's actually a couple of other aspects of risk that we were also quite thoughtful on. And one of the ones, and I think this is really true of sustainable finance overall, is that if we say it's going into the fight against COVID, it really needs to. Like, you've got a kind of effectively a risk that you fund something and it goes into something completely different. So we established a whole governance structure and a sort of checking process where we had developed, if you like, a impact checklist. So say, okay, this industry into this country, this has a high impact, and clearly a country that's had a very heavy hit from the pandemic or is particularly low income gets a higher weighting. And then we had to build into both the sort of audit process and the documentation a number of checks to make sure the funding was going definitely to that thing, and it was ring fence to do so. So that was the second issue. So I think getting that balance between the two was really key.
No, because some of the things that you're learning in the process are going to be applicable going forward. You're going to have floodings, you're going to have typhoons, you're going to have, islands being flooded out, things like that. Now, the thing is that it is still a moving target, isn't it? You made the commitment last year. Are you still running that program right now? Have you increased the amount that is being committed to this? And the fact that the first 3 months of the year look very different from the next 3 months, right? You are talking supply chain changes, and the countries that need the vaccine are very different from the countries that needed the PPEs, that kind of thing. So this moving target thing, right? How are you dealing with that? And is the program still running?
Yeah, the program is absolutely still running. And I think to your point, but it has evolved. So I think at the beginning of the crisis, I think one of the things that we were hearing back as a big bottleneck was PPE. You've just talked about, and there's a big focus around, okay, how do we scale that? Going further into the crisis, then there was a particular issue around certain medication that was potentially sort of alleviating the symptoms or ventilators. So we funded quite a large, actually the single biggest chunk of the fund so far has gone to the creation of ventilators, which now we're pivoting very much to how do we scale the vaccine. So the vaccine's there, how do we finance the supply chain, particularly into low-income countries where they're probably not as, they haven't had the opportunity yet to, or the ability even, to secure directly from the manufacturer. So we're working very closely with a number of different people across Asia, Africa, and the Middle East in terms of that deployment.
So what's coming back to you in terms of a brand, a customer, core customer pool? What's staring back at you right now from that program? And the kind of engagements that you are creating as a result. You will have a lot of your own staff, committed to looking at some of these requirements, these requests coming in, and so on. What is being created right now, do you feel, as the sustainability head of the organization? What do you sense in terms of what is your organization becoming as a result? What can you honestly say it has had an impact in the bank?
I mean, I think the first thing, to be honest, is that the bank genuinely just wanted to make a difference and felt that this was a crisis. So I don't think we went into this with any other aspiration than saying, look, we have to contribute to what is a crisis, global crisis, a crisis particularly for the markets that we operate into. How can we do that? Well, one of the things that we can do clearly is just by financing the stuff that needs to happen as a reaction. And I think also we're very thoughtful about trying to be there for our clients, as many of our clients also wanted to go through the same thing, but that may have required capital expenditure or operational costs that they didn't have at the time. And so this loan kind of provides that bridge for them to then rejig their operations to do that. I think, right, to your point around what's coming back, I think what's coming back is an awareness for the change that we can really have, and our ability to do that in some extraordinary markets that really need, that we're going through some really tough times. So if anything, it just underlines this point that the bank, Standard Chartered, can play a really powerful role during these sort of crises and changes, and that we can really support our clients when it really matters.
Here's one indicator that just came to my mind, which is your share price, right? Your share price has sort of, hovered around what it's been doing for most of the year. It didn't go too high up or too way down. Who are going to be the winners when COVID eventually, phases out? And in terms of financial institutions, the institutions that are taking advantage of what the pandemic is making institutions do. How do you think it's going to play out post-pandemic? How much of it is going to be rewarding for Stan Chart, and how much of it is business as going back to business as usual? What do you like to see, and what do you think is happening?
I wish I had a crystal ball, and then I'd be able to answer that question comprehensively. But I mean, my perspective is this. The two big trends that were there before the pandemic hit us, that got massively accelerated through the pandemic, and I can only see accelerating further, are digital and sustainability. And so if you think about any institution, and frankly any company, forget any institution, I think this is applicable globally. The companies that are going to do really well, I think, in the next sort of coming horizon are the ones that have the biggest pivot into those two things, digital and sustainability. And certainly that's something that we have absolutely internalized and very much pivoting the bank towards doing. And then I think the third one, as I mentioned, I think in terms of sustainable finance specifically, I think we've seen this big growth and this big focus around the records that have been hit and everything else, which is really positive because we do need more capital to move into this space. But really the next wave, I think, is going to be focused on, okay, how do I ensure that we're having the real impact that these bonds are, the debt that's being raised, the equity that's being raised is really having. So I think the next bounce of the ball in sustainable finance is very much going to be about focusing on driving impact to where it really matters. How do you move the needle on climate change, for example? Well, over the next decade, the thing that's going to move the needle biggest will be an investment into Asia and pivoting Asia as a whole, its business models, its manufacturing capability, everything else, to a low carbon future. And I think that's a huge opportunity, and it's one that Stan Chart is completely focused on trying to help drive.
Right. And of the regulators that you speak to, which ones very helpful, which ones you're having good conversations with, and you can see that there's a dynamism both ways, and perhaps you would not mention names, but are there regulators who are also still in the education aspect, or still sort of trying to sort their way out in trying to understand impact and finance?
Well, I think that first of all, I have to say, I think we're all trying to still figure it out. I think, before I sort of talk about what the regulators need to do as an industry, I think we've got to make this easier, right? There is an alphabet soup of different definitions, acronyms, standards flown around what ESG is, and I think actually one of the things that really helps, drive a better, more effective market moving capital, as you mentioned, is kind of education, and B is standardization, and then three is transparency. Right. And I think that's one of the things that we've really very much tried to live by example. So that's why we've got, our definition of sustainable finance, our framework is up on our website. Anyone can use it. Anyone can download it. That's why our impact report goes out every year. And that's why we're very much articulating it. So I think the finance industry, frankly, has to get its own house in order. I think you are seeing a number of regulators move. I think, look, the Europeans have sort of set the tone in terms of the EU sustainable finance taxonomy. I think that is a really coherent and thoughtful piece of regulation. However, it is not appropriate for non-European markets. And so I think where I encourage both the Europeans and other regulators to think about is, okay, well, how do we take that and then put it into an Asian or more broadly an emerging market kind of context, so that it is driving capital aligned to those things, and recognizing that, say, Bangladesh is not in the same place as Belgium and has slightly different challenges and has a slightly different pathway to being net zero and Paris aligned. And so I think that's where it's really key. But I think you are seeing regulators really stepping up to this challenge as well. I mean, I think it's interesting that Hong Kong, for example, put out I think it was a white paper or a green paper, forgive me for getting one of those wrong, on sustainable finance in June, right, last year, at the height of all these issues. And it shows you that the regulators very much are sort of agreeing with the view that the pandemic has accelerated this forward. And as we think about how we build back better or how we come out of this stronger, we do need more capital to move into these more sustainable areas. And that is a shared challenge, not just for the banking industry, but for the regulators and investors as well.
Actually, one of the regulators whose position on impact and environment will have a global impact is the UK regulator, right? So, and now with Brexit and the fact that the EU has done far more deeper and more meaningful work with the taxonomy, is it just a matter of exporting the taxonomy to the UK and then globalizing it, or are there calibration work that needs to be done? Are there differences in understanding some of the goals? And especially because in the EU, there's a lot more government subsidies, for environmental and impact, and the EU and the UK sort of needs to sort of step up in a way. But what do you see are the calibration work that needs to be done there?
Yeah, I think this is a really important point, because on one hand, to grow a market, to grow an industry for sustainable finance, one of the things that will really help is a standardization of regulation, right? So we don't want a multitude of different regulations in this space springing up. But at the same time, effectively climate is about science. I mean, there is literally a defined pathway from a scientific basis of how much carbon you need to take out of the system in order to be aligned in different countries. And so we need to effectively get that balance right between a consistent global set of standards that everyone can kind of get aligned to, that will facilitate the flow and allocation of capital, but at the same time recognizing sort of some of the individual country differences. So I think there are two broad groups that are playing a really important role here. One is the Network for Greening the Financial Sector, so the NGFS, which is a collection of central banks, and has a very wide representation. And I think that is being very thoughtful and is kind of pushing forward on this space. And the other is now what's emerging, and the UK has just joined it, is the International Platform for Sustainable Finance, which the Europeans have kind of created. And the work stream on taxonomies is being led jointly by the Europeans and the Chinese. And so I think we're going to see both of these two really starting to try and set some of these global standards to really support the growth of this industry more broadly.
Do you think the BIS? Yeah, sorry, go on.
No, I was going to say we've got COP coming up, and COP26, which is going to be hosted in the UK, and I think you're going to see a lot more in the run-up to that, a lot more focus on that. And I think one of the things that we haven't had an opportunity to talk about yet is carbon markets, because I think one of the things that we very much feel, and one of the areas where I think, again, we need to see further development is in creating a credible, deep carbon market. One, because I think, frankly, we need to see an effective carbon price, which needs to be much higher than where it is at the moment. And then a good price signal will then start shifting capital accordingly. And the other thing is that to hit our commitments around reducing net zero, reducing emissions and moving towards net zero, the first priority has to be business model change, has to be actually taking carbon out of the processes. But there are some really hard sectors that we don't yet have the technology to do that with. So if you look at steel manufacturer or even things like cement, we haven't yet got scalable solutions. There's some emerging technology, but they're not fully scalable. So in the short to medium term, we then need to offset that, which is why I think carbon offset markets are really important. And it is why, and Bill Winters, our CEO, is co-chairing the Task Force for Scaling Voluntary Carbon Markets, which is a big component going into COP for the end of this year.
Right. I mean, in fact, there are a few carbon market objectives or goals that are coming up soon, right, for the airline industry and all that. The thing is that, do you think that carbon, the whole carbon agenda was actually originally moving way too slowly? And what was the problem, do you think, there? Was it the problem of monetizing that market, that would have given it a bigger impetus? Your answer to this is going to be very important, because what I'm also trying to test with you here is really the noble goals of becoming more impact-oriented and all that, and the business or objectives that you can meet, that you will be rewarded as an institution, that there is profit in there, and so what do you think could have happened? And this is a personal opinion more than an institutional opinion. Could have happened in the carbon market that could have made it move faster, or do you think that it's going to move faster now as a result of more concerted efforts?
Well, maybe looking forward first, I think it's definitely going to move forward, sort of faster going forward. I mean, you've only got to look at the number of companies and institutions that have made net zero commitments in the last 12 months. And I think you're going to see, again, that accelerate with a change of administration in the US, China's net zero commitment, and then the move towards COP26 at the end of the year. So I think we have seen a greater awareness and a greater focus from the private sector on the need to move to net zero. And that will drive companies and institutions to then start saying, okay, well, if I can't get there in the medium to the short term, what steps do I need to take? Well, I need to start thinking about credible offsets. The big issue that we've seen in the offsets market is it's not transparent, it's not deep enough, it tends to be over the counter, so there isn't a kind of a quotable market out there. And that's very much what the Task Force for Scaling Voluntary Carbon Markets is looking to do. How do we create a credible, deep market that really can get scaled? And I think there's a big opportunity for Asia here, because Asia contains some of the biggest natural carbon sinks, both in terms of forests and sort of mangroves and seagrass, as well as actually being at the center for potentially some of the technological innovation that we're going to see to really drive this. I think, China, for example, played a huge role in driving down the cost of solar and hence its ability to get applicable elsewhere. I think we now need to see that same kind of cost curve reduction in technology happen in things like CCUS, hydrogen, and other areas. So that, for me, I think is a big opportunity for Asia, and one where I think the carbon markets actually can help start driving more capital into these kind of new technologies, for example, to really bring them through that cost curve much quicker than we saw in renewables and solar and wind.
Yeah, in fact, I'm curious about this because, think about this, Bitcoin moved much faster than the carbon market, right? The carbon credit market. And the motivation for Bitcoin, was in fact really fictional. The whole love of Bitcoin and all that. And I'm a big fan of it, but what drove that and what didn't drive the carbon credit market makes me curious, like what is required to build a market. So that was the purpose of the question.
Well, it's also,
last question.
and I think, sorry, Emmanuel, I was just going to say, I think Bitcoin uses, and I may get this wrong, so I speak under advisement, but I think Bitcoin uses the same amount of power as Austria as a country does.
Well,
so
that's true too.
From a sustainability perspective, I think, I'm a big fan of technology, and I think there's a lot that can be solved.
And how is it that
the route out of the climate crisis, is going to be through technology ultimately. But we do need to be thoughtful about these new technologies that come on and making sure at the start that they are sustainable. So there's a lot in digital ledger technology. Bitcoin at the moment, I think, may have gone not the most sustainable route.
No, thank you for bringing that up. And despite that, it's done well. And it's got a following, and it's got the depth of the market, and it's got derivatives and futures and everything going for it. So what happened that carbon credit, didn't move as fast? Last question, right? And this can be a general conversation, because I'm as much tapping your brain on this, because it's the issues rather than StanChart specifically. And you've actually given me a good sense. And I also know your institution well. I know that the KPIs that you've mentioned will be funneled down to the right down to the loans manager, and they'll all be reined in terms of commitment and focus and all that. Is going up the league table important to you? Issuing bonds. I mean, you're not anywhere on the league table at the moment, and that's what your competitors or your detractors will say. What needs to come out to show that you're a major global player in impact and ESG?
Yeah, so I think a very fair challenge. I mean, what I would say is, I don't think league tables are really reflecting an ability to affect change. I think that, for me, that's the key thing, right? So when we're raising these green bonds and sustainable bonds and everything else, I think they're a really powerful tool, but a tool in order of what? A tool to drive capital to supporting either a shift to better low carbon, climate friendly business models, or to increasing sustainable living standards, achieving the sustainable development goals. So I don't think we're not setting a sort of a target in terms of league tables. I think over time, you'll see league tables themselves adjust to trying, to be impact weighted, if you like, in some consideration. But I think absolutely what I want to do is make sure that when our clients and customers think about sustainable finance, think about sustainability, we are number one in their perspective. So that, for me, that will be the judge for the future of Standard Chartered. And it's something that, I think we've got a lot of good momentum, focus, and innovation to really connect to.
Daniel, Hanna, we're going to hold you to that, okay? And we'll probably do another conversation next year, and just do an update to see, how you've been moving along. And by next year, the agenda itself would have evolved, and we would have a better perspective whether the pandemic-related euphoria on impact and ESG will then settle into a more definitive trend that will transform financial services, your bank and every bank in the world. So thank you very much for spending the time with me explaining what you're doing.
No, my pleasure. And I actually truly do believe that we are moving from sustainable finance to just finance that is sustainable. So a real pleasure to talk to you. Thank you.
I'll let you have the last word on that one. Thanks.
Bye-bye.
Excellent. Thank you very much.
Thank you.